Looking at the Markets with David Modell.
Welcome to Looking at the Markets with David Modell. I've got a repeat guest here, a very popular one. People keep requesting him. He is Mr. Seth Golden. So let's get right into it because we're going to talk about volatility, which is Seth's favorite trade. We're also going to talk about retail and what's going on for the rest of 2018 and into 2019. Seth Golden, welcome back to Looking at the Markets.
Thank you very much, David. Thank you for having me back. I'm excited for this discussion, and it's been a little while, so let's get this thing going.
Absolutely, and I want people, by the way, to visit a number of things involved with Seth Golden. Phenomgroup.com. There's going to be a link in the description below this video. You could just click on that. I made it easy for you, or you could just go in your web browser to phenomgroup.com. Also visit Seth Golden on Twitter at SethCL, also on stocktwits.com at Seth Markets. Seth Marcus. So yeah, you're right. It's been a little while, and there was some crazy volatility. In February, all of 2017, low volatility. We're talking VIX around single digits, the 9 level, sometimes getting into the 8s. Then we had the vol-apocalypse in February and March. So what have you been up to since then with phenomgroup.com?
So February was really just an interesting period. Like you said, we saw the VIX go from 15 to 50. In a couple of days. Had one day move was just over 100%. That brought about just a lot of panic in the volatility complex. I mean, there's tons and tons of traders that trade volatility. Lots of hedge funds that trade volatility. They have these core strategies that they use to trade volatility, and a lot of people during that time period got harmed. Some of them irreparably. A couple of funds in Chicago had to close up shop. But prior to even coming into 2018, so it was November 2017, I had wrote an article, and David, you probably remember this. In November, I had wrote an article because I had seen the influx of people coming into trade volatility, especially shorting volatility. It became so popular. I just thought that these newer entrants to the trade needed more information and somewhat of a warning, especially with regards to how they were trading volatility, what instruments they were using, whether they were doing options or common shares, things of that nature. So I did this really long, you could say it's a report, warning them on specific instruments, mostly XIV and SVXY, two that I just didn't touch because of what I outlined in this report. And in no way, shape, or form was I validated by what did happen. I said specifically, kind of stay away from these two instruments, and those two instruments were the ones that saw the most severe reaction to the February spike. But since then, we went into that spike underweight. We had limited exposure. We were actually, some of the few people that were, I don't want to say glad that what happened, with volatility happened, but gave us the opportunity that we were looking for. We are looking for a volatility spike whereby we can add exposure. And so, of course, you had everybody, on TV, CNBC, Bloomberg, you name it, TD, Market Watch Live, blaming the short vol traders for what happened back in February through March. The market correcting, I think at its trough level was like 13% down, or give or take. But that's just not how the market works. No one specific trade can cause a market correction. It can compound it. And I would acquiesce to that perspective that some of the short vol trading positions, I mean, we were at record levels in the short vol trade, did compound the issue. But it wasn't the cause. The cause was interest rates moving around and people not quite sure how to value rising interest rates against equities. But to make, kind of to bring it all home, I would say, from that period to now, we've done very well. We stuck with our core strategy, which is to short volatility. And if you had shorted volatility in February through March through April and held on to it to, this day, you would have done extremely well. Some of the instruments had another reverse split, UVXY, reverse split again, back in February. Oh, this will never reverse split again, TVIX. Excuse me, this will never reverse split again. The short vol trade is dead. What happens? We're in a bull market. We're in an expanding economy. We have rising earnings, some 20% EPS growth. The market's going to trend, according to how earnings are being delivered. So we've done very well. And at Phenom Group, we just continue to service our subscribers. Every week we have a research report. It's the weekly research report, and it's all macro in nature. It's all talking about the macroeconomics as well as earnings. Rarely do we get into individual corporate reports or things like that. We're more, because we are a volatility centric site, we focus on the macro. I feel if you understand the macroeconomics, the earnings picture, and the market sentiment as we go through these time periods, you do very well with volatility trading. So that's what we do every week. We started back in February. We also started our private Twitter feed so that we can deliver scalp and swing trade opportunities for our subscribers. Because while we're holding on to a core short volatility position, there's numerous occasions where on the daily basis, on a weekly basis, you can scalp, the volatility exchange traded products, for a 1%, 2%, 3% move on any given day. Yeah. So we started that as an additional service, and we've done phenomenal with it. I mean, our private Twitter feed, I guess you could say success rate when it comes to our alerts is in the 90 percentile. We've had maybe 2 or 3 losing trades this year. One of them was very disadvantageous because the company that we were short got bought out, and there's nothing you can do in a case like that. But these are small positions, so it's nothing of great consequence. But in general, we're 90% in the 90 percentile success rate with every single scalp or swing trade opportunity that we deliver. And of course, we also have long-term investment thesis that we've done very well with this year. Our best one, I think, to date was Anadarko Petroleum. We had like a 35% return on. We've done swing trades on that as well. So I mean, if you add all of the swing trades for that one, we're in the 40 percentile profit. Right now, we like the financials, so we're holding on to that one, even though it hasn't done very well. But you get a lot at phenomgroup.com. You got a lot of social applications where you can share. You have a chat room. We have videos, blogs, all kinds of stuff. It's really a very interactive site. So that's what I've been up to.
That's a lot, and it's fantastic. You've been doing great. So I wanted to get your broad view of the economy. Where do you see it going for the remainder of 2018?
Most of the economic data is pointing, in a positive. It's trending positively. Whether you look at just today's retail sales numbers, you look at small business sentiment, you look at CPI, PPI, PCE, personal consumption and expenditures, your broadest based GDP numbers, most everything is trending positively. So in terms of just the economy, I don't see that stalling out here in 2018. I think we're going to finish up the Q4 period very strongly, especially once we get into the the peak of holiday retail sales shopping season, I think you're going to have a lot of upward surprises. So I think 2018, we're looking very good on an economic basis. The market is a beast of its own, but if the earnings continue to come in as they have during the first 2 quarters of the year, it should follow along with the economy, or vice versa. You know, the market follows the economy follows the market. So
fair enough. All right, so let's go ahead and backtrack to that interesting period in February. How did you manage volatility then and since then?
So we were underweight. You know, I usually try to keep about on average a 20% short volatility exposure in my portfolio through the year. But coming out of 2017, you know, where you had the VIX, the median on the VIX was 1111. I mean, it's just going to be really hard to measure up to that in the following year, especially as rates are rising. So, you know, my theory then was I'd like to cut exposure and cut leverage. You know, in the past, I had preferred UVXY. In fact, from 2012 to 2017, that was my primary, you know, volatility exchange traded instrument, UVXY. Feeling that volatility was going to have somewhat of a reflexive comeback in 2018, I transposed my instrument of choice to VXX, which is only a 1x instrument as opposed to UVXY, which back then was a 2x or 2 times instrument. It's since been cut back to 1.5 leverage. But so those were 2 of the ways that I managed my volatility exposure and stayed in the game, if you will. I had only about 12 to 13% exposure going into that February spike. Excuse me. And I was only on a 1x instrument as opposed to a 2x instrument. And since then, I had built my core up to 21.5% at my peak. Probably by April was at 21.5%. And then around, I want to say July, I started to pare that back, just because, you know, the profits were so substantial. Sure. And, you know, here we are, you know, basically, let's say February to July. That's a long period of complacency, you know, I would think. So we were ripe for a little bit of a bout of volatility coming around the corner. But in September, on September 12th, actually, I had tweeted out. We alert our Phenom Group subscribers as to our plan, how we're managing our exposure, our volatility positions on pretty much a week-to-week basis. Okay. You know, we're at 21%, we're at 19%, we're at 18%, so on and so forth. So on September 12th, you know, after, you know, because our subscribers get, you know, first dibs, of course, but on September 12th to the public, you know, I let people know that I was down to 10%. Yeah. 10% VIX ETP exposure. And here we are now in October with a nice volatility spike whereby I can recapture a lot of those positions, some 20-25% higher than where I covered them. You know, that's pretty much how we do it. We look at the macro environment, we look at the sentiment of the market, we look at trends. You know, how long has the market been complacent, to draw out a hypothesis and action plan, what we should do with our positions. And we've managed very well to stay out of, you know, trouble, if you will, such as the volatility spike in February.
Yep. Done a fantastic job with that. So I want to get into I want to pick your brain a little bit, get into your head. What are you looking at in order to guide your volatility market exposure? What are some of the metrics for you?
So many, but you know, if I was not to get too technical, I guess, sure. And then I will get a little technical just from an educational standpoint, because I think it's valuable for the audience. You can look at the volatility index, which tends to lead the VIX itself. So if you see the VVIX, volatility index, if you see that starting to edge of 95, 100, means that there's a lot of call options being bought for volatility.
Yeah.
Tell you there's a lot of people hedging. You can look at skew in the 140s, tipping 150s. That's high. Means that there's just a lot of general hedging going on the call side and the put side in the SPX options market. So those are two really big ones that you want to kind of always keep those tabs open or check in on them at least once a day. The skew itself, doesn't, I think, update on CBOE until the end of the day, so you can check it at the end of the day.
Sure.
Unless you have some kind of live feed.
Right.
Another one is volatility dispersion. This one's a little bit more technical. Volatility dispersion, if it gets too low, which is exactly what happened in February, it got to around 0.8. You want to see volatility dispersion in the 1 to 2 range, and this was down to 0.8 back in February. And a gentleman by the name of AJ Thrasher of Thrasher Analytics, he posts it somewhat regularly, the volatility dispersion graph.
Okay.
And he had been posting it in September. Again, he had been recognizing that it was basically getting down to the levels that it was back in February, 0.81 at one point in September. And that's what told me, okay, volatility dispersion is way too low. It's basically when markets are just completely uncorrelated or sectors are completely uncorrelated. They create this dispersion metric. So the XLY, the consumer discretionary ETF, is doing its own thing. And then you've got the XLF, the financial sector spiders ETF. It's doing its own thing. You've got the technology sector doing its own thing. None of these markets are being correlated, which also helps lower volatility. Yeah. But at some point when they come back together, when markets correlate, you get these massive sell-offs. And volatility dispersion can be your leading indicator that is about to happen. 4 out of the last 6 times when the volatility dispersion has gotten all the way back down to about 0.8, we've had a massive sell-off on the nature of a 3 to what happened in February, which is 12-13% market sell-off. So it's not 100%, it's not foolproof, but that's why you have all the other metrics, such as volatility index, such as skew, and a host of you can look at breadth, you can look at market breadth.
Okay.
I tend not to, even though a lot of people do, the advanced decline line, because if you're looking at the advanced decline line, there's so many things that exist today that didn't exist 10, 20 years ago. The ETFs, for example. Your bond funds. What do bond funds have to do with the stock market? A lot of those are in the NYSE. So when you're looking at it, you've got to extrapolate those to really have any meaning of what the advanced decline line is. So I tend not to look at it as much as a lot of other people do. And of course, a lot of people will say, well, it was an indicator this time. You want it to be an indicator, okay? It's only an indicator to the extent you want it to be. It just doesn't measure up like it used to.
Got it. So, I'm learning so much. Volatility dispersion. That's a new one for me. The dispersion. Okay. So when you've got different sectors of the economy and the markets manifesting different levels of volatility, that's the dispersion. Okay, that's interesting.
And nothing's really correlated. The Russell's not correlating to the SPY, to the SPX or the Nasdaq.
Yeah.
Index can be doing their own separate things. We saw the Nasdaq break down first. Well, we saw the Russell break down first. Then we saw the Nasdaq break down, but SPX and Dow was still getting to its all-time highs when the Nasdaq was breaking down. So those are examples of volatility dispersion, of how the markets are just not correlating.
Yeah, and when that metric gets down to the 1 or below 1 region, it's possibly trouble ahead. Got it. Okay, but that's one of many measures that you use.
Exactly.
Wow.
And
Okay.
and think about, if you think about what it takes to get there, you need these prolonged periods where the market is rising.
Yeah.
You know, it's not just going to get to a sub one, reading overnight.
Yeah.
It needs time to get there. Well, it coincides with an extended period of complacency in the market.
Yeah. Understood. Wanted to talk about consumers, something that you're always watching. You're watching consumer sentiment, consumer habits.
Yes.
Yeah, that's what you do. So how would you describe the consumer at present right now? And do you have a forecast as far as consumer spending goes?
Forecast for consumer spending? Not so much. I mean, I think consumer spending, it always stays in this range of 0.2% to 0.6%, with like a median in the 0.4% range. So I don't think it'll vary too much, but I do think come November it's going to start to shoot up again. So far as consumer spending has been, it's been great. It's been boost, really just following the cash flow that the average household has. The debt to income ratio of the average household nowadays is back to levels that we haven't seen since 2002. So for all of the rising interest rate concerns, or higher prices at the pump and higher crude oil, the consumer is actually is in better shape than they've been in the last since 2002. So that's 16 years.
Right.
So I think consumer spending is going to, like everything else, I think finish the year very strongly. Consumer sentiment has been at all-time highs. Well, not all-time highs, but at decade-high levels for the last 2 months. So there's not a lot of issues with the consumer, despite what some may herald in today's retail sales report. But you got to take that into context, and maybe we'll get into that a little later. I can kind of weed through what was in that report to get the audience to understand it was not as weak as what was delivered, because we'll get into that later.
Or better yet, go to phenomgroup.com. Get the full. There's only so much we can say in a video here. If you want the full reports, you got to go to the website and check out the chat boards as well over on phenomgroup.com. Would that be correct?
Yeah, I had actually in the weekly research report, I had warned our subscribers that this particular retail sales report may disappoint for 2 reasons, and they were bookended, and both of them came to fruition. So it's the details that we deliver at phenomgroup.com that really stand out, I think.
Yeah, fantastic. So let's get to individual picks. I know that my viewers love the picks, the stock picks. Do you have any retail picks for this holiday period? Any ideas you want to share with us today?
Yeah, let's see. We like Walmart. We think Walmart had a fantastic quarter. Their last report, the stock shot from $90 to $101. It's since pulled back a whole bunch. It's like $93. It's been in a range of 93 to 97 for like the last month or so. But we like it. We think that their online sales channel, their gross margins, their same-store sales are going to continue to perform very well through the back half and the end of the year. I know that there's some issues around tariff concerns and things of that nature, but those tariffs aren't set to they're not set to hike prices until next year. So while some people are kind of slamming on the brakes today, they may be doing that too soon. So we like Walmart. We've liked TJ Maxx for a long time. That's another one that's performed extremely well. Its valuation is stretched, can't deny. But over time, TJ Maxx has always done you right. And if you believe in this economy going through the holiday shopping period, how can you not like TJ Maxx? It's got a really good business model in the fact that it's not a traditional department store. It's a treasure hunt store.
Yeah.
That's one of the categories, if you will, of retail that has continued to do well. We like TJ Maxx. I like Target. I like Target. I've liked Target since last year. I bought it at $53. I've been holding on to it in the Golden Capital portfolio ever since. I'm a little disappointed, that it hasn't really taken off and held the $90 level. I think, again, that's just a lot of rotation out of the retail sector. The dollars have come out of the retail sector over the last 30 days in a big way. I think we've seen almost all of the department stores, hypermarket stores, apparel stores pull back pretty significantly. So, those are three that I like: Target, Walmart, TJ Maxx.
Got it. Okay. How do you think, I want to talk about inflation, the I word, inflation. How do you think this plays into the fourth quarter and into 2019?
So broadly speaking, and you probably know this about me, David, I don't believe in inflation. If you look at the definition, you almost have to eventually hit the pre-expansionary high levels. We're not going to do that. We haven't done that since the 80s, in fact. We have not done that. We haven't done that on 10-year. We haven't done that on Fed funds. So where's inflation? What we tend to get is reflation. So we can reflate from lower levels, and we seem to always find lower levels, but we keep on hammering home the idea or the terminology inflation. So from a theoretical standpoint, I don't believe in inflation. I believe in reflation. Okay. I don't know that it's going to be that impactful, though. Again, it comes down to, will it impact certain? I'm sorry, I should caveat that. Will inflation impact certain industries? Yes. The auto industry it's very sensitive to interest rates because your average monthly payment will go up, and that may curtail your choice as a consumer. Okay. Instead of going into a mid-size SUV, you might have to settle for a compact SUV. Yeah. So it'll impact certain industries. Of course, housing. We see a slowdown in housing, but it should caveat that also. We always, if you look at new home sales through the course of this expansion cycle, it's always higher and higher, but it always has these pullbacks and then restarts, if you will. But same thing with housing. I think we are this late in the cycle going to see that slowdown more sustained. I don't think housing is going into a recession whatsoever. The demand is there. It's the inventory. The inventory is a huge problem, which is also serving to boost the median average home price in America, making it that much less affordable. And then you throw, higher monthly mortgage into the equation. You've got a double-edged sword there that doesn't work in favor of the housing industry, and we've seen that in the XHB ETF for housing. It's all it seems to do is go down. So, but at the same time, those two industries shouldn't be able to offset what's going on with the consumer and what's going on in the retail and service sector, which continues to be very, very strong. So from that standpoint, I don't see inflation being a big impact this year. It may prove to be more of a headwind next year when we kick off that much more Fed rate hikes. When you go from 0 to 2.5% in the course of two and a half years, it's a condensed period of time, but you can handle that. You go from 2.5% to say 3.25%, which would equate to about a 6% 30-year mortgage. That can be stifling. That can be stifling for both credit cards and the housing industry. So we'll have to see how that works out next year in 2019. But for 2018, we may get one rate hike. I would keep my eye on the CME Fed Watch tool every day. That's another one to check out. Okay. The CME Fed Watch tool has a 100% success rate of forecasting the probability of a rate hike. 100% since its began. So if it says that we're going to get one, if it's above 50%, we're going to get one.
Yeah.
Right now, I think it's at 81%.
Okay.
So there's a very strong chance right now that we are getting a rate hike in December. It will fluctuate, between now and then. It may come down or it may go up to 96% like it did for our most recent rate hike. But that's one for the viewers to keep a tab on as well, the CME Fed Watch tool.
Gotcha. I'm writing that one down. That's valuable information right there. Now, if we were to paint a picture for investors for 2019, what do you think we can expect to see? What's 2019 going to look like?
I think 2019 is going to be that much more of a volatile year for stocks than 2018, which has already proven to be somewhat of a elevated volatility in the market this year. So I think the returns are going to be, well, there's two schools of thinking. I'm of the opinion that we won't see double-digit returns on the S&P 500 next year. Okay. The other school of thinking is that when you have multiples being compressed, when the S&P 500 multiple is compressed during an economic expansion, usually it explodes in the following year. You're just kind of resetting the PE clock, and right now we're at about a 15.7 12-month forward-looking average on the S&P 500, which is below the 5-year average. So we're either going to explode to the upside, or we're going to, have less returns than we are in this year. I still think we're going to finish this year substantially higher than where we are today. But next year, I'm not as optimistic as you would say. I still think we have a positive year next year. I just don't think it'll be as strong as 2017 or this particular year.
Got it. Okay. And I know that one of your subscribers, what I like about Seth Golden is he communicates with his subscribers on phenomgroup.com. He's very active there. If you have questions, just ask him, and also, as well as on Twitter and StockTwits. But if you really want to get the details in depth, you got to go to phenomgroup.com. So one of your subscribers on phenomgroup.com asked, "What's your worst trade ever?" Are you willing to reveal that?
Yeah. It wasn't even all that bad. Well, I mean, I don't want to come off braggadocious or anything, but I've been investing and trading for almost 20 years now, and I'm generally not taking any real substantial losses during that period. One of my lesser trades was going into 2008 with an Amazon short that I was heavily underwater with, but through the grace of a bad economy, it came in and I was able to close out with a profit. But more recently, I had invested. This was an investment in Whole Foods Market. And I'll explain why this was, what I learned. I'll explain what I learned. So I had invested in it. I was down about 30% at one point. It came back, and I was only down about 14%. I had been in the stock for over a year. Like I said, it was an investment, and nothing was changing in the fundamentals of the company. The sales weren't improving, the earnings weren't improving, the media headlines were getting worse and worse, and management was not believable at this point. So I cut my losses, about a 14% loss after a year. That was my worst recorded loss ever. Unfortunately, what made that one so painful is, I think 2 weeks later is when Amazon acquired them.
Yeah.
So and they didn't acquire it for a substantial premium, but it would still have made my losses even less significant. What I learned though from that, what has helped me since, is if management says that they believe their total addressable market is XYZ, make sure you validate it, okay? Because 9 times out of 10, management is wrong. We've seen this with Fitbit. We've seen this with GoPro. We've seen this with so many companies. It's usually the the consumer goods, the consumer packaged goods companies that misrepresent or misunderstand. They're not trying to, misrepresent, but they believe what they're drinking. They're drinking their own Kool-Aid, and they believe it. But when it comes to a niche company such as Whole Foods Market, and there was another one that got bought out also, the same in Florida. We have them in Florida. Not Whole Foods Market, but what's the other one, David? Yeah. I forget what it's called, but there's another chain also, just like Whole Foods Market. And with these niche business models, what they don't tell you is that they believe that they have an opportunity of the total grocery retail sales when they don't. Look, there's a shopper that can buy a $10 jar of peanut butter, organic peanut butter, and there's a customer who can't. Yeah. And that's what you have to ask yourself when you hear management say we can get to 1,200 stores, because that's what Whole Foods has been telling investors for years. We believe we can get to 1,200 stores, or maybe it was 800. To this day, they still, even after saying that for years and years, they're not even at 500. They may just be getting to 500 with the new concept that they started, but there was never any chance of that happening, just because there are different consumers. There are consumers that can buy that $10 jar of peanut butter, and then there's the consumer that's at Walmart or at Target buying the $3 jar of peanut butter. So you have to ask yourself, is my management team telling me a believable story? And Whole Foods wasn't. Okay. They just weren't. So that was my lesson learned.
Always validate. Trust but verify. One of our presidents once said. Yeah, management can be overconfident, or sometimes they fudge the numbers a little bit. It could happen. So I've heard. All right. Yep. So look, I know you've been doing some really great work over at phenomgroup.com. For the audience's sake, can you tell us what people can expect from your work over at phenomgroup.com? And can you tell us some of your winners in 2018 so far as stock picks go?
Yeah, sure. So I deliver a daily market dispatch every day. And it generally is macro in nature as well, with some of the concerning geopolitical issues of the day. Yeah. But I try to do a rundown of a snapshot of what's going on in the market right now, and what are the probabilities over the next couple days, week or so. So you get a daily market dispatch, and then we deliver a weekly research report every Sunday morning. The weekly research report is long. It can be 7 to 8 pages with various graphics and verbiage, but we always try to cover the earnings picture and how it changes every single week, whether it's data from FactSet or from Thomson Reuters. It's always in our weekly research reports. We always look at the expected move in our research report. We believe that this is a valuable tool. Investors need to know what the weekly expected move is for the coming week. Is it a $38 move on the S&P 500, or is it a $78 move? That can, give you some kind of indication of what's going to happen next week. Yeah. And it's somewhat tradable as well. As we get, through the first 3 days of the week, if you've only seen a $2, $3 move, and the weekly expected move is $30, something's got to happen on Thursday and Friday. Right. We deliver all of the different sentiment survey reports, and what was the key economic piece of data that moved the market during the week, and then of course a look at the week ahead. Here's what we expect. Updates on our volatility strategy and things of that nature go into our weekly research report. We also have video blogs of what we think are pertinent on how to trade the market. What are these stochastics? What does this chart represent? And how to chart, how to trade, how to be a better trader. So we have a really rich video library on site for our premium subscribers and our contributing members. And then we also have just your charts, everything that you can access from TradingView on your own. It's up there. Just click on it. You want to do your own chart, you can do that. All the social applications, we have direct messaging, friends, groups, all of that fun and interactive stuff on our site you can engage with. So, and then our trade alerts. We have long-term investments that get delivered right to our premium subscribers' email address, and through our private Twitter feed, you can access our daily scalps and swing trades. We average we were averaging upwards of 5 a week coming into I would say, August. But because of how extended we believe we were getting in the market, we had been cutting that back down to about 3 a week. But 3 a week, if you can average a 1% move on each one, there's 3% into the coffers every week. So,
Yep.
And all of that is available to our premium subscribers. So there's a wealth of information, of data, of research, etc. Some of our best picks this year. We've done Twitter on a number of occasions. Like I said before, we also had a really fantastic pick on Anadarko Petroleum. Facebook. Facebook's down to 150, Seth. Yeah, but we got into it. We got into it when it was at 190, and our target was, we try to get 10% out of all of our investments. We try to get 10%. Went up to 215. We got out. It subsequently tanked after that, but we stuck to our, we wanted just a 10% move, got our 10% move, and we got the heck out of Dodge. So that was another really good one. What else? XRT in the beginning of the year we did. That worked out fantastically. Got our 10% profit. Got the heck out of Dodge on that one too. Again, one that we're in right now is XLF, the financials. We're about flat on it right now. Starbucks is another one. This one went sideways on us really quick. We got into it earlier in the year during the first quarter. Subsequently has done nothing but go down. But we dollar cost average, so we're actually profitable on it now. It's come almost all the way back. If we're profitable on it because we dollar cost average and we get the positive benefit of the dividend. We believe that it's going to have a strong report finally this quarter. I shouldn't even say a strong report. The fact is, Starbucks reset expectations. And when you reset expectations, what do? You reset them low. So that's what they did. And we don't think it's going to be this, gangbuster report. We just think it's going to show investors, hey, we're not falling off a cliff here, Right. So I think that's going to be a good one as well. So we're in Starbucks still. So those are some of our picks throughout the year.
And Seth Golden keeps coming with those picks. Fantastic. So what you want to do is you want to go over to phenomgroup.com, click on that link in the description below this video, or just type it into your browser or into your phone and sign up for that premium subscription after you check out the site.
Sorry, the one that we did last year, I think in one of our videos last year was Chipotle Mexican Grill. We got into October of 2017. And everybody hated Chipotle back then, and then in Q1 it delivered a really strong report and went up at its peak like $150. Got a 30% profit on that one, so that was another good one.
Fantastic. All right. Also check out Seth Golden on Twitter. It is at SethCL, and also on StockTwits.com. If you're a StockTwitser like I am, he is at Seth Marcus. All right. Is there anything else you wanted to mention to my audience, Mr. Seth Golden?
Yes. I want to mention that I'm very happy to see Mr. David Modell tying the knot. Congratulations, yes, sir. Wendy is a beautiful, lovely woman. I had the pleasure of meeting her and having dinner with you guys in person, so that was great. Very, very excited and happy for you. Thank you. Yeah, it's coming up soon, late October. October 28th is the big day, and you think after I've been in the markets for so long, nothing would scare me, but
This is different. This is different than stocks and options. I got to get used to this. But you know, I'm just gonna have to. I'm gonna have to ride it out, and you know, it's great. She's amazing. So. Thank you, Seth Golden. I appreciate it. We have to do this more often. We took a break, but we are back in full force with phenomgroup.com and looking at the markets. So thanks a lot, Seth. We'll bring you back soon, all right?
Thank you, David. Have a good one.